What is peer-to-peer lending?
Peer-to-peer lending is an online platform that connects people who need to borrow money directly with individuals who want to lend. Instead of using a traditional bank or lender, borrowers and investors interact through a digital marketplace, streamlining the process and often making loans more accessible and potentially more affordable or profitable for both parties.
How the platforms connect borrowers and lenders.
Borrowers apply for a loan by providing personal and financial details. The platform evaluates their application and assigns a risk rating. Approved loan requests are listed on the site. Lenders can then choose which borrower or loan to fund, sometimes pooling small amounts from multiple investors to make up the full loan amount, diversifying risk.
Funding and loan disbursement.
Once enough investors commit funds to a loan, the platform aggregates the amount and disperses the money to the borrower. The borrower then repays the loan over time with interest through the platform. The platform automatically distributes the repayments to the individual investors who contributed to the loan.
The role of the platform.
The platform acts as an intermediary, handling loan application verification, risk assessment, and repayment processing. They usually charge fees to borrowers and sometimes to lenders. The platform also manages collections in case of late or missed payments, though there is still some risk involved for lenders.
Benefits and risks of peer-to-peer lending.
P2P lending can offer borrowers access to loans at potentially lower rates and give investors the chance for better returns than traditional savings. However, both sides should be aware of risks such as borrower default. Always review a platform's terms and risk disclosures before participating.